Karen, great to speak to you again. When you look at China, I don't know how you play China at the moment. It does seem that they're going after a lot of industries that they consider critical. How far could that crackdown actually extend to?
Yes, it's a good question, Francine. And you can see this has rattled investors. We've seen a significant shift in the valuations of Chinese stocks over the last few months. I think this reflects two things. One, it is, China has a much longer term view of how it's going to run its economy. It's less interested in short term profitability. It really has emphasized this focus on sustainable growth, avoiding bubbles, excesses in the short term for the long term sustainability. It also, I think, is taking the issue of consumer protection and protecting and being in control of the systemic parts of its economy. It wants to maintain that control. So many of these interventions on the financial sector are really about having that aspect of control. So how, as investors, do we interpret this? How deterred should we be? Not terribly so. I personally think that this focus on sustainable growth is appropriate. I think the outlook for that sustainable growth of the Chinese economy and the opportunities for growth are still very evident there. And ultimately, China knows, Beijing knows, it's got this balancing act to achieve with the global capital markets of making clear that it wants to regain or it wants to maintain a degree of control, but it really doesn't want to deter international capital. The reform and reopening, which of course has been a key part of the strategic plan from Beijing for some time, is really critical to the future growth of that economy. It needs international capital. It needs international investors to continue to support that growth. So I think they're going to be, balancing that act. And I think the opportunities from that growth of the Chinese economy as it matures are just too significant for investors to back away from.
So as an investor, Karen, could we see a policy mistake actually from Chinese authorities, or given the track record of PBOC so far, that's extremely unlikely?
Yes, exactly, Francine. There's concerns about aspects of what's happening in the real estate market at the moment. But I think what we have discovered for the last 10 years is that Beijing is extremely good at fine-tuning its policies. When it sees the economy perhaps performing a little bit too strongly, as it did coming out of the pandemic, it did tighten up its credit conditions, it slowed things down. But as things need another boost, I'm very convinced that we'll see that. So we have these very short tightening and easing cycles. It's very different to what we've seen here in the West. If we look at the credit impulse, for example, in China, they're almost these 2-year cycles where they're constantly fine-tuning, adding a bit of growth, taking away from growth. But the experience is that it works. This is the beauty of having that significant control over the economy that they maintain, and having that network of influence via the banks, via the local authorities. When they need to top up growth, then they have the ability to do so. So I think that really, for me, limits the possibility or the downside risks of things going materially wrong. And of course, they're internally financed. And that really is the foundations of them being able to continue that process of fine tuning. They're masters of their own destiny because they are internally financed.
Karen, give me a sense of what you do with UK assets, given we had GDP figures today that were pretty encouraging.
Yes, well, I think we have to sort of distinguish, of course, whenever we look at the UK with what are the assets in the financial system that really reflect the UK economy. Sterling is the most obvious one, and we have seen, as the strength of the economy translated into the Bank of England giving us a slightly more hawkish monetary policy report recently, we've seen sterling be the key reactant and that appreciation of sterling. Which could have further to go as the economy really does get further back on its feet, and we see the Bank of England perhaps even bring forward some of that tightening. I think with the stock market, the domestic stocks, we think, like I said with the US earlier on, I think the UK is actually really beginning to fire on all cylinders. If we look at those underlying drivers of growth, The labour market, very strong. The housing market, too strong, arguably. But all of that sets up for quite a strong consumer coming into 2022. And so the domestic stocks, I think things look pretty good, and perhaps the outlook is underappreciated. There's some opportunities there. When we think about the larger cap space in UK equities, we've just got to remember that two things are going on. One, there's quite a lot of weight to energy and mining, which is therefore less about what's going on in the UK, more about the Chinese story and global demand. But also, of course, sterling interplays, because those repatriated earnings, as they're bought back, if sterling is higher, then there's a detrimental impact there. So I'd say overall, still expect modest upward pressure on sterling going into year end. Domestic stocks look pretty good, possibly even more repricing to happen in UK curves. But it's perhaps the lowest down on my preference set there is the larger cap, just because of how sterling interplays and the composition of those international stocks that are in the basket there.
Karen, thanks so much. Karen Werther, JP Morgan Asset Management EMEA Chief Market Strategist. Now, coming up.